Hello, I'm Philip Smith, financial planner with Tide Pool Wealth Strategies, dedicated to helping late career professionals navigate the tides of retirement planning with clarity and confidence. This is your retirement planning guide to money management, pursuit of long-term financial growth, and creating an adaptive strategy tailored to your unique and evolving journey. In every episode, I'll share concise, actionable insights to help you plan a retirement of purpose, resilience, and confidence. Welcome to
The Perfect Retirement Plan?
Hey there, I'm Philip, and today we're tackling a question I get a lot from folks in their final working years. How should I adjust my investment portfolio as I approach retirement? If you're 5 to 7 years away from retiring, you might be wondering, am I still invested too aggressively? Or maybe I'm playing it too safe. Will I outlive my money? Let's wade into this together and break down how to balance growth, income, and safety as you approach the retirement tide pool. Here's why your investment strategy may need to change as retirement approaches. When you're in your 30s and 40s, it's all about growth. You can take risks because time is on your side, and usually that account balance is smaller than it will be in another 20 years. But when you're in your 50s and 60s, the game changes. Retirement isn't 20 years away anymore. It's right around the corner. This is when you need to shift your focus from growing your nest egg to protecting it and using it. Think of your portfolio as a retirement engine. It needs to provide steady income and keep running smoothly for 20, 30, or even 40 years. Hey Cash, what's the biggest risk for those on the precipice of retirement when it comes to their investments?
The biggest risk for people entering retirement is experiencing a major market drop in the first few years of retirement. It's called sequence of returns risk, and it can derail even the best laid plans.
Yeah, if the market tanks right when you start withdrawing from your investments, it can shorten how long your money lasts. Now, my obligatory disclosure. Cash, cover me.
All investing involves risk, including the possible loss of principal. There's no assurance that any investment strategy will be successful. Also, rebalancing may trigger a taxable event depending upon the type of account. Be sure to consult with your tax professional before taking any specific action. This is especially necessary if you aren't working with a financial advisor who can provide some education on your specific investment-related accounts.
Right. Gosh, that was a lot. So then, what's the right balance between growth, income, and preservation? What's the magic mix? It depends on your goals, risk tolerance, timeline. But here's a general principle. You want to keep some growth. Stocks can still outpace inflation, which is critical for a 30-year retirement. You also want to add income. Bonds, dividends, and cash provide stability and reliable income. And of course, you likely want to preserve what you've built. At this stage, you probably can't afford to lose 30% of your portfolio in a bad year anymore. The days of set it and forget it are over. I get it. Market volatility can be scary. But cashing out to hide your money in a mattress won't cut it, because then it does zero work for you. Going all in on cash in savings or CDs isn't the answer either, or at least it's not a great answer. Inflation will eat away at your purchasing power faster than you think. Here are a couple strategies to reduce risk. First, consider adding more bonds or bond-like investments to your portfolio. Bonds don't grow as much as stocks, but they provide predictable income and stability. Second, look at dividend-paying stocks. These stocks can provide both income and the potential for growth. Cash, what was the latest inflation rate heading into 2025?
The projected inflation rate for 2025 is about 2.5%, according to the Federal Reserve's long-term target.
A slight improvement. Inflation might be lower than recent years, but it's still a silent drain on your savings if you're too conservative. Here's a question to consider. When should you rebalance your portfolio? Rebalancing is when you shift money between stocks, bonds, and other investments to get back to your target mix. In an IRA, there wouldn't be any tax ramifications for rebalancing, but if you have a taxable investment account, sometimes called an individual, TOD, or joint account, there may be taxes to deal with as a result of rebalancing, which triggers selling some of your investments. For late career professionals, in other words, pre-retirees, I recommend checking your portfolio at least twice a year. Why? Because as the market moves, your portfolio can drift. What started as a balanced 60% stock, 40% bond split might now look more like 70-30. For example, a 60-40 portfolio consisting of stock and bond indices would have likely become nearly 80% stock from the beginning of 2023 to the end of 2024 if left unchecked. That means you're taking on more risk than you intended. Regular rebalancing helps you lock in gains and stay aligned with your retirement goals. Now let's dig a little deeper into the tools you'll use to create stability and income in retirement. And by tools, I mean investments. Bonds are like the quote-unquote seat belt of your portfolio. They traditionally keep things steady when the stock market swerves. You could look into treasury bonds, corporate bonds, or bond funds depending on your risk tolerance. You could also consult with a financial advisor. Dividend-paying stocks are a great income vehicle for retirees. Companies like these pay you a portion of their profits regularly, which can act like a paycheck. And then there's cash. With my clients, I like to keep at least 3 to 4 years worth of expenses in cash equivalents like money market accounts or direct bond holdings, short-term stuff that would mature inside of that 3 to 4 year window. I emphasize direct bond holdings because bond funds fluctuate. If you own shares of a mutual fund that consists solely of bonds, it has a share price. It will fluctuate. You buy them at a share price, and then that price can go up and down, which can create the risk of selling for a loss. With cash-like stuff in your account, if the market dips, you don't have to sell investments at a loss to cover your bills. There are some common mistakes to avoid, like being too conservative. One big mistake I see is going 100% cash stable, selling all your stocks and sitting in cash. I understand the instinct. Nobody wants to lose money. But remember, a retirement that could last 30 years or more needs growth to keep up with or to outpace inflation. The other mistake, not updating your investment strategy at all. If you're still investing like you're 35, you could be taking on unnecessary risk. So yeah, all in all, just a few things to ponder. Cash, what did I miss?
So much. Where do I begin? Just kidding. Seriously though, you've provided a pretty good overview without getting specific to the person. What do you want to do next?
Let's take some action on this. What can you do today to adjust your investments for retirement? Step 1, take a look at your current portfolio. What's your mix of stocks, bonds, and cash? Step 2, ask yourself, is this aligned with my retirement timeline and my comfort with investment risk? There's more to think about with risk than this, but this is a basic level for decision making. And step 3, if you're not sure, sit down with a financial planner. We can help you figure out your target portfolio mix and make adjustments without overreacting to market noise. Some parting words as we wrap up. Your investment strategy needs to evolve as you get closer to retirement. The right balance of growth, income, and preservation can give you confidence that your money will last as long as you do. Thanks for tuning in to the Perfect Retirement Plan, or as I say, the perfect retirement plan. Today, we waded into one of the biggest questions pre-retirees face: how to adjust your investments for retirement. And we really just scratched the surface. Remember, it's not about having the smartest financial advisor, the most money saved, or the highest probability of retirement success. The perfect retirement plan for you is the one you act on.
It's disclosure time. This podcast is intended for educational purposes only, should not be used for any other purpose. The views depicted in this material should not be considered specific advice or recommendations for any individual, are not intended to be financial, tax, or legal advice, and do not represent Tide Pool Wealth Strategies or Cetera Advisor Networks, LLC. For a comprehensive review of your personal situation, always consult with a financial, tax, or legal advisor. Neither Cetera nor any of its representatives may give legal or tax advice. Our office address is 450 Country Club Road, Suite 350, Eugene, Oregon 97401. Securities and advisory services are offered through Cetera Advisor Networks, LLC, a broker-dealer, registered investment advisor, and member of FINRA and SIPC. Cetera is under separate ownership for any other named entity. Whew.